Welcome to this video. Today we are going to explore one of the oldest and most respected theories in stock market analysis, the Dow Theory. Whether you are a complete beginner or someone who has been investing for a while, understanding Dow Theory will give you a rock-solid foundation for reading market trends. So let's get started.
Section 1. Who was Charles Dow? The Dow theory is named after Charles Henry Dow, who co-founded Dow Jones and Company and created the famous Dow Jones Industrial Average in the late 1800s. Charles Dow never actually wrote a book about his theory. Instead, his ideas were published as a series of editorials in the Wall Street Journal, which he also co-founded. After his death in 1902, his colleague William Peter Hamilton compiled these editorials and formalized what we now call the Dow theory. It remains the foundation of modern technical analysis even today. Section 2. The core idea. The central idea behind Dow theory is simple but powerful. The stock market moves in trends, and these trends, once established, tend to continue until there is a clear signal that they have reversed. In other words, if the market is going up, it will likely keep going up. If it is going down, it will likely keep going down. The job of an investor is to identify the direction of the trend and trade along with it, not against it. Section 3. The six tenets of Dow theory. Dow theory is built on six core principles. Let us go through each one carefully.
The first tenet is that the market discounts everything. This means that the current price of a stock or index already reflects all available information: earnings, news, global events, investor sentiment, everything. By the time you hear a news headline, the market has already priced it in. This is why trying to trade on news alone rarely works. The second tenet is that there are three types of market trends. The primary trend is the major long-term direction of the market, a bull market or a bear market, lasting months to years. The secondary trend is a correction within the primary trend, typically lasting a few weeks to a few months. The minor trend consists of daily fluctuations that are mostly considered market noise and are not very useful for long-term investors. The third tenet is that primary trends have three phases. In a bull market, the first phase is accumulation, where smart and informed investors quietly start buying while public sentiment is still negative. The second phase is the public participation phase, where the broader public starts noticing the uptrend and begins investing. Prices rise sharply during this phase. The third phase is the excess phase, where everyone is talking about the market, valuations become stretched, and smart investors begin quietly selling to the excited public. In a bear market, the same three phases happen in reverse: distribution, public participation in selling, and finally panic. The fourth tenet is that market averages must confirm each other. In Charles Dow's time, he used two averages: the Dow Jones Industrial Average and the Dow Jones Transportation Average. His idea was that for a true bull market to exist, both averages must be making new highs together. If one average is rising but the other is not confirming, it is a warning sign that the trend may not be genuine. In modern analysis, this principle is applied by comparing different indices or sectors to confirm a trend. The fifth tenet is that volume must confirm the trend. In a genuine uptrend, volume should increase when prices rise and decrease when prices fall. This shows that the buying is backed by strong conviction. If prices are rising but volume is falling, it is a warning that the uptrend may be weak and could reverse soon. Volume is the fuel of the trend. Without it, the move is suspect.
The sixth and final tenet is that a trend remains in place until there is a definitive signal of reversal. This is one of the most practical principles of Dow theory. Just because a market has been rising for a long time does not mean it is about to reverse. The trend continues until proven otherwise. Investors should not assume a reversal just because prices seem high or low. Wait for the market itself to confirm the change. Section 4: Bull Market versus Bear Market under Dow Theory.
Under Dow theory, a bull market is confirmed when the market makes a higher high followed by a higher low, meaning each peak is higher than the previous peak and each dip is higher than the previous dip. This pattern of higher highs and higher lows is the classic signature of an uptrend. A bear market is confirmed when the market makes a lower low followed by a lower high. Each bottom is lower than the last, and each recovery fails to reach the previous peak. Recognizing these patterns on a price chart is one of the most valuable skills any investor can develop. Section 5: Practical Application.
So, how do you actually use Dow theory in real life? First, look at the long-term chart of the index, say the Nifty 50 or Sensex. Identify whether it is making higher highs and higher lows or lower highs and lower lows. This tells you the primary trend. Second, check the volume. Is volume supporting the price movement? Third, look for confirmation across sectors. Are most sectors participating in the move, or is it only one or two? If the trend is up and all three factors confirm it, that is a strong signal to be invested in the market. If the trend is down and confirmed, it is a signal to be cautious or exit positions.
Section 6: Limitations of Dow Theory.
Like any theory, Dow theory is not perfect. Critics point out that it is a lagging indicator. By the time a trend is confirmed, a significant portion of the move has already happened. It also does not tell you which individual stocks to buy or sell. And in today's complex global markets, with algorithmic trading and high frequency trading, pure Dow theory signals can sometimes be noisy or misleading. However, despite these limitations, the core principles remain valid and are embedded in almost every modern form of technical analysis.
Outro.
To summarize, Dow theory teaches us that markets move in trends. Those trends have phases, and volume and confirmation are essential to validating any move. It is one of the most timeless frameworks in investing. If you found this video helpful, do like and subscribe for more such educational content on stock markets and trading. Thank you for watching, and I will see you in the next one.